In this video, I will show you how to trade regular and hidden divergences like a professional trader. Using divergence is one of the most powerful tools you should have in your arsenal. It tells if momentum is returning to the prevailing trend or slowing down. Knowing this information will help tremendously. You will know if you should trade with the trend, hold on to your existing positions, or even look for a counter trend setup if you understand how to apply regular and hidden divergences. When combined with price action, trend, and support and resistance, it can be a highly profitable trading strategy. So in this video, I want to show you why divergences are so powerful and help you spot them easily so that you can incorporate them into your trading. Sounds good? I would appreciate it if you could smack that thumbs up button and subscribe to this channel. It helps support this channel so that we can keep delivering value to you. If you are new and do not know about our giveaway, we do a giveaway for every single video we release. So if you want to win access to our premium Forex signals, which we usually charge $99 a month for, look for an emoji throughout this video. Once you find the emoji, like this video and comment on what the emoji is plus win Forex signals in the comments section. We will announce the lucky winner in the next video, so make sure you subscribe to the channel and hit the notification bell to know when the next video is released and whether you have won. Now let's talk about what a divergence is first. Most indicators out there are based on price, meaning that they lag price and follow the price direction. If the price goes up, then the indicator goes up and vice versa. If you look at a simple moving average, you will see that this is true. However, sometimes you will see that there is a discrepancy between the price and the indicator. The price is showing one thing and the indicator is showing another. That's what a divergence is. It is important to note that you won't see this on all indicators. You can only apply this to certain indicators. And I'll show you a couple of them later on in this video. So keep watching. There are two forms of divergence: regular divergence and hidden divergence. A regular bearish divergence occurs when the price is making a higher high, but the indicator is making a lower high. The opposite is true for a regular bullish divergence, where price is making a lower low, but the indicator makes a higher low. Regular divergence is a leading indicator that can pinpoint market tops and bottoms with high accuracy. I've previously talked about how you can combine both leading and lagging indicators to build your trading strategy. But for now, let me show you more examples of regular divergence. In this chart, price was in a bullish trend with higher highs and higher lows being created. However, if we look at the MACD indicator, the MACD failed to register another high. On the contrary, it made a lower high. So essentially, there is a divergence between price and the indicator, which we call a regular bearish divergence in this case. This is a strong sign that the market has peaked and a reversal may be underway. Here's another example with the price being in a bearish trend. We see price making lower lows and lower highs. But if we were to look closely at the MACD indicator, we can see that the MACD made a higher low. So this is what we call a regular bullish divergence. Moving on, I want to explain what a hidden divergence is. It is my personal favorite because it helps you enter into an existing trend. And you should know that the easy money always comes from following the trend, not against it. So keep watching because hidden divergence will really help you. The main difference between a regular divergence and a hidden one is that the regular divergence indicates a reversal, while the hidden one indicates a trend continuation. Because the hidden divergence is a trend continuation play, you want to see price making a higher low in a bullish hidden divergence. You want to see the indicator making a lower low instead. Let me break down the idea behind the bullish hidden divergence. The indicator previously made a low indicating oversold. When the indicator makes a lower low, this indicates that the price is even cheaper. Combined with a higher low in price, that is a sign that the retracement is over and the price is likely to resume its prevailing trend. The opposite is true for a bearish hidden divergence. You want to see price making a lower high and the indicator making a higher low instead. Let me show you an example of a hidden divergence. Here, we have price in a strong uptrend followed by a pullback before making another higher high. If we were to look at the oscillator recorded a lower low during the pullback and formed a bullish hidden divergence. This signals that the price is likely to resume its prevailing trend, and in this case, you can see that price did precisely that. Here's another example, except that this is a bearish scenario. Here we have the price trading in a strong downtrend, and we can see that price is consistently making lower lows and lower highs. If you look into the oscillator, you will notice that the oscillator recorded a higher high during this pullback. That's our bearish hidden divergence there, and look at what happened to price afterwards. Earlier on, I mentioned that you cannot apply divergence to every single indicator. Right now, I want to show you the best indicators that you can use to identify divergences, so keep watching. The first indicator that I've previously talked about in other videos is the relative strength index. Let me show you briefly how you can identify both regular and hidden divergence using the relative strength index. Here's a regular divergence, and here's a hidden divergence. Nothing too tricky so long as you understand the concept. If you want a more potent indicator than the relative strength index, then make sure you check out my other video which talks about an indicator that is far superior to the relative strength index because it incorporates volume into the equation. I won't spoil it for you here, but I will leave a link to that video at the top right corner and end screen of this video. I recommend you watch that video next after completing this one. The second indicator that you can use is the moving average convergence divergence, or otherwise known as the MACD in short. Again, nothing too complicated here. Look at the MACD line and signal line. Compare it against price to see if there's any divergence. The third indicator that you can use is the stochastic. It functions very much like the MACD, and here's a quick snapshot of how you can use it to identify divergences. And the last indicator that I recommend you use is the Commodity Channel Index, or CCI in short. It is an indicator used to measure the variation in an instrument's price relative to its statistical mean. I've yet to record a video about this indicator, but if this is something you are keen to learn, do leave a comment below to let me know. Here are some examples of how you can spot divergence using the Commodity Channel Index. As you can see, knowing how to use the indicators is relatively straightforward if you understand how to look for divergence. This is why I spent quite some time in this video to explain the concepts of regular and hidden divergence to you. If, for some reason, you only watch this portion, you should return to the start of this video and understand how to spot them. These indicators will not automatically identify the divergence for you, so you need to pick it up yourself. You do not have to use all the indicators I provided above. In fact, you should not, as it will clutter your chart. Instead, pick one that you are most comfortable with and start practicing identifying divergences. A quick tip that I have for you is to focus on divergence that occurs on the higher time frame, ideally the H4 time frame or higher. A higher time frame signal will be more reliable, so it is best you stick to the higher time frame, especially if you are new to trading divergences. And that's all I have for you in this video. I hope you got value. Remember to like this video, subscribe to the channel and comment with the emoji plus win Forex signals to enter yourself into our giveaway. The winner will be announced in the next video, so turn on the notification bell and check to see if you have won. Thanks for watching. I'll link to the video that talks about the indicator that is more potent than the relative strength next. You can use that indicator to detect divergence as well. I highly recommend checking it out right away by clicking on the video end screen over here.